Invest Africa, proudly brought to you by KPMG.
Hello and welcome to Invest Africa. I'm Nozipho Banjo. Now, the rising middle class and the need for financial inclusion will be the key driving force in Africa's growing financial services sector. But on a global scale, Sub-Saharan Africa remains the region with the largest portion of people excluded from formal financial services. Does the statement pose an opportunity or a threat for investment on the continent? Joining us today in Johannesburg is Carlijn Nouwen. She's a partner at Dahlberg. Also in Lagos, we're joined by Adetorera Banjo, Senior Manager of Management Consulting at KPMG Nigeria, and Jude, Anele, the Head of Direct Banking at Diamond Bank, also joining us from Nigeria. Thank you so much for making the time to join us. Let's start off with a question posed to you, Adetorera, just to help us with the definitions around the rising middle class in Africa. This is a concept that's becoming all too often branded about. Who are we talking about exactly?
Okay, thank you. If you look at Africa, before, Africa was known as the uninvested and banked continent. But because of the growing population, the growing middle class, who are basically the people that have access to financial services, access to disposable incomes, they have continued to increasingly grow in Africa, thereby making the activities in the financial sector space much more lucrative and then open for financial investment or foreign direct investment into the country. Also, because of the urbanization that's going on in Africa, and then also improvement in infrastructure, some sort of stable democracy and economic landscape, we see a lot of potentials, particularly for the growing middle class.
Jude, is this a homogeneous group? Are we speaking about the same group of people across the African continent?
Yes, but I'd like to look at it more from the perspective of opportunity. Of course, in Africa, we can rightly say that there's been a resurgence of the middle class, but we also think that this could also be more improved if we get more people into the formal financial services system. As we speak, if you take Nigeria, for example, you find a lot of young people above the age of 18, the age of contract, financially excluded. So I think that there still lies a great deal of opportunity in Africa to swell the rank of the middle class from a financial inclusion perspective.
Carlijn, why are there large swathes of the rising middle class that are locked out of mainstream financial services?
That's a great question. In general, there are roughly 3 misconceptions, very common misconceptions, that stop financial institutions from banking the unbanked and the underbanked on the continent. Firstly, there's the thought that they must be poor and therefore they don't have money, so they're not interesting banking clients. And the question you just asked, Jude, is it a homogeneous group? It actually isn't. It's quite a wide range, from self-employed to people who are in the lower paid income classes. So they have a variety of different financial needs that you really need to cater to, but it doesn't mean they're poor. The other 2 main misconceptions that stop financial inclusions or financial institutions from banking these people is one, that they don't understand banking, they don't understand financial services, and therefore a lot of time and effort needs to go into financial education, which they usually don't consider their role. And thirdly, that they don't have any financial products at all right now, so you really have to start from scratch. Many of these people bank with either community banks, savings circles, microfinance institutions, and are relatively savvy financial consumers, just not included by formal institutions.
Not included by formal institutions. Adetorera, let me come back to you. What is it that is keeping financial services and formal financial institutions from seeing the opportunity that the bottom of the pyramid or the largely unbanked represent, if we're saying that this is a significant part of the African population?
I think one of the reasons why banks are shying away from that informal sector or from the bottom of the pyramid is, one, the risk associated with that sector. If you look at lending, for example, there would be a lot of development if banks, for instance, lend to the small businesses. But because of the increased risk, inability to ensure that they secure their funds back, banks would typically shy away from this sector. And we know that the small businesses are basically the economic engine for growth in Africa as a whole. So what is imperative for banks really is in terms of coming up or developing, innovative, sophisticated products that will probably meet the, differentiated needs of this bottom of the pyramid, and sort of also have a way in terms of assessing the risk and lending to this sector.
Adetorera, I have to bring you in this part of the conversation, and maybe let me take it to Jude. Rather, as a player in the banking space, the allegation is that traditional financial institutions risk or see this particular sector as too risky, and because of them being risk averse, then they don't service that particular sector. Give us a sense of whether this kind of thinking is changing, and whether innovative approaches, as suggested by Adetorera, are actually coming to market to get traditional banking institutions closer to the poor.
When it comes to financial inclusion, I think the first two key products that we think that financially excluded people could have access to is payments and savings. Credit comes third. And payments, we believe, is something they're already doing, although informally. Savings, they also do quite informally. So we are thinking of having this large amount of people come into the formal payment system and the formal savings system. And of course, when they save, you get to understand their behavior better. And then, of course, on the basis of that understanding and data available to you, can determine whether to lend to them or not. For instance, in Diamond Bank, we have a financial inclusion solution called Better Savings Account. We started it off as a savings account, and then we've migrated to pilot a credit or loan product on it, layered on the savings account. So it's based on our understanding of the behavior of these customers. Based on the data available to us, we are going to test a loan product. And if you look at Kenya and Tanzania, of course, you find that they've made a lot of great mileage in terms of lending to these people. It's only in Nigeria and maybe probably Ghana where you find that access to credit is very, very limited, most time below 2%. But in Kenya and Tanzania, they've made a lot of progress in that space. So, but I think that the issue is also around banks having their locations more around the urban and semi-urban centers. Until you begin to reach the rural areas, then it begins to catch on. But you also find that having the brick and mortar branches in the rural areas is not economically workable. Of course, that's why you find a lot of emphasis being placed on agent banking now. So you have an already existing infrastructure in terms of the mom and pop shops serving as agents of banks or mobile money operators to render financial services to these people. Because you have to look at the economics. Most of them look at the economics, it doesn't make sense. But with agent banking, with some mobile access, which we have in abundance in the rural areas, they could achieve this. For instance, in Nigeria, about 64% of adult population live in the rural areas. You also find that about 62% of adult Nigerians have access to mobile phones. That also tells you that most of these adults in the rural areas have access to mobile phones. So coming up with a solution that is mobile driven is also quite a way of getting these people financially included. But we must start from savings and payments, and then before we begin to migrate to credit, which means that you have to understand them a lot better.
Let's borrow this model that Jude has given us, Carlijn, payments, savings, and then credit. And also let's pull in the East African example that is put on the table. M-Pesa is obviously one of the leading products. How do we get it right? How do we replicate the successes of M-Pesa for broader impact on the continent?
Yeah, I was very excited to hear the examples that Jude gave about innovation based on an understanding of the customers, because that's really what it boils down to. If you want to bank the unbanked and the underbanked, you will have to innovate in products and services, in distribution models, and getting to a low cost to serve. And M-Pesa is a great example, but you can't just cookie cut that across the continent. If I can give some examples of different financial needs within this group, and I'll just take 3 different groups that would all fall under that rising middle class and are largely un or underbanked. You look at a farmer. A farmer has a relatively predictable income, but it's incredibly seasonal. So if you were to extend or develop a loan product for a farmer, it would have to have a grace period that allows the farmer to first buy the seeds, grow, and then post-harvest, when he has the income, start paying back. Maybe even a grace period on the interest. On the other hand, if you look at unbanked very large trade networks, such as you have in many different countries, ranging from Senegal to Kenya, many of these traders need to act very, very quickly. They have an opportunity to be included in a particular trading deal, and then their loan application takes 2 to 3 to 4 weeks, and the opportunity is closed, the window is closed. So a cash flow based lending product, as Jude referred to, understanding their payments and their savings behavior, and based on that designing a lending product allows them a very short turnaround time. And then the third example is a large group of SMEs, and that was spoken about also already. They are the engine of growth for Africa, but many of them are very informal. They will not have audited accounts, they have very little collateral for loan products, but they may have actually a relatively stable history, and if you look at their payments and savings behavior based on their cash flow, you can start extending them loans to grow their businesses.
Adetorera, I want to pose the final question before we go to break to you. What I'm hearing from Carlijn as well as from Jude is that there needs to be a shift in the way traditional financial institutions look at verifying credit worthiness and how their systems and processes engage with the poor. From your perspective, do you get a sense that that bridge is being met with financial services institutions really tweaking their business models so that they are able to meet the needs of the farmer that Carlijn speaks of?
If you look at the financial institutions, and if I take Nigeria as an example, I think it's clear that most of the institutions are now looking at ways to, look at their operating model, see how they can actually capture this unbanked market. They're also trying to leverage a lot on third-party agencies in terms of attracting this unbanked population. There's a lot of pressure in terms of bringing in the deposits, a lot of pressure in terms of, if you take the mobile payment, for example, in Nigeria, at least anybody below between 15 years old and above, at least half of that population have access to mobile phones. And for those underbanked and undeserved population, this may actually be their only access to financial or formal financial services. And we see a lot of banks actually, looking at the mobile banking, looking at internet, looking at how technology and payments can actually help to improve the access to finance for the unbanked population. So if I take a typical farmer from our example, a typical farmer would likely have a mobile phone in Nigeria as we speak now. So the onus is on the banks to ensure that they're able to make it accessible in terms of bringing in financial products into that mobile phone, making payments easy, making things like payments to their sort of distributors easy for the average farmer in the urban market. Clearly, in terms of the reach of commercial banks, when we look at branch and ATMs, they may not be there in terms of reaching the urban area, but they can also leverage on things around the third party, or what I'll call the agency banking concepts, using the post office, using the mom and pop shops to actually attract some of these deposits into the formal sector.
Well, let's take a short break on the back of that analysis on how traditional financial institutions can increasingly tweak their business models to meet the needs of the unbankable or the bottom of the pyramid rather. When we come back, let's pick up the conversation on the necessary conditions to better serve the poor. Let's look at the regulatory environment and other issues that are related. Let's take a short break. We'll see you straight after this. Welcome back to Invest Africa, and still with me in the Johannesburg studio is Carlijn Nouwen. She's a partner at Dahlberg, and joining us from Lagos is Adetorera Banjo, Senior Manager of Management Consulting at KPMG Nigeria, and Jude Anele, Head of Direct Banking at Diamond Bank. Jude, let's come to you with this question. Let's talk about the necessary environment to better serve and better bank the poor populations. And I want us to particularly touch on regulation, because earlier you spoke of the mobile technology innovations that we're seeing out of East Africa. And to a large extent, that has been attributed to a deregulatory environment, if I may describe it as such. What is your view on the extent to which financial services should be regulated, and whether this curtails innovation when it comes to servicing the poor?
I think apart from the chemical industry, the financial services sector, in my view, will be the most regulated sector globally, and understandably so. Of course, these are people that deal in trust on behalf of other people. Now, people generally don't trust bankers, and that is the truth, whether they are banked or underbanked. So a great deal of credibility and trust needs to be built. And I think this is where the regulator comes in, or the regulators come in. So across insurance, pensions, and banking, so to speak. And I think that providing that regulatory framework or environment where people believe they can trust banks, do business with them, access credit, understand the products, and also have access to conflict resolution mechanisms where they have issues with the bank, then that will also improve and grow credibility. That is one. Two, there's also that balance between security and convenience. So for instance, if you take Nigeria, you'll find that there's been some issues around insurgency, that's terrorism, for instance. Now, if you want to play a lot in the payments area, you're very careful as a regulator to ensure that you also don't go facilitating terrorism in terms of payments. And that is why sometimes the regulators are very careful on what they do. So, for instance, the regulators in Nigeria had come up with a three-tiered Know Your Customer initiative, which is KYC, for instance. That, for instance, at level 1 allows you to get in customers without necessarily having a valid means of identification. Very little documentation required, because these are some of the issues that form barriers for financial inclusion in Nigeria. But what you find now and again is that the regulator is quick to tweak it in such a way to provide some measure of security, thereby also trying to tighten what he has already loosened. So there's that ambivalence that comes from the regulatory perspective. So that is one. Two, when it comes to technology platforms, it's also important that these platforms are very robust, and most times they are quite expensive. So if you look at the core banking applications conventional banks use today, the commercials are usually done on a per customer basis. Now, you will agree with me that most people in the financially excluded space are low-value customers, in quote, in terms of the value of the transactions they do. So if you, on a commercial basis, in terms of core banking application, you're using commercials on a per customer basis, then it becomes economically unworkable. Now, so that means that you have to go look for another solution where you can aggregate people and on a pooling basis charge the banks, which makes more economic sense. Now, that also means that you also have another sort of banking application that you have to plug in. And you understand that once you start plugging one or two applications together, interfaces where failure could occur increases, and customer experience may also drop. So these are some of the challenges we have. But purely, I think that regulators have a very big role to play. And in Nigeria, I must say that the Central Bank of Nigeria, with the other partners in insurance and in pensions, especially FINA, for instance, which is also an NGO that is promoting financial inclusion in Nigeria, have done a great deal of work in terms of providing that stable and comfortable financial services environment for financial inclusion to thrive.
That's a lot that Jude has put on the table, and perhaps maybe just two issues that I'd like to pick up on, Carlijn. The one is remittances, which we know is really the lifeblood of and the flow of money, especially amongst the poor across borders, and the kind of practical challenges that creates. And the other issue that he's just raised in the latter part of that analysis was around insurance. And the question then becomes, has microinsurance been an enabler of inclusion for the poor when it comes to financial services?
Great. Let me touch on both of those. So first, remittances. You rightly say so that is the lifeline for many people at the lower end of the socioeconomic spectrum. And what you see is that there's not that many financial institutions yet that have managed to capture both sides of the remittances equation. So on one hand, having strong networks in the diaspora, either in other African countries, there's a lot of financial flows between South Africa and other African countries, or in European or North American countries where many of the diaspora live. On one hand, you need to tap into those. On the other, you need to tap into the recipients in the underbanked or unbanked communities. And those have very different ways of engaging with financial institutions and designing yourself in such a way that you capture both and therefore can capture as a financial institution the value of that whole transaction is something that very few financial institutions so far have gotten entirely right. But there's a lot of potential. On the recipient end, and we've spoken a lot about mobile banking and mobile payments and digitizing, which is great to bring the cost to serve down. On the other hand, though, many of these economies are still very cash-based, and there is a bit of a chicken and egg problem around putting digital money in people's hands and their ability to use it or not to use it. So on the recipient end, you also need to think about what vendors can people use that digital money at. What cash out opportunities do they have? Because in the early ages of getting used to it, people trust their cash still more than they trust the digital money, and knowing that you can actually cash it out somewhere and use that cash is important to have that uptake. As for your second question around insurance, insurance is an interesting and tough subject. It's a relatively complicated financial product that even in many developed markets, many consumers don't fully grasp. So microinsurance, there have been some success stories, more so in the non-health related situations as in health related situations, because there's a need to have a really big risk pool with insurance. The most innovative models that have been really helpful, for example, is Kilimo Salama that Syngenta started, where they embed a index-based weather insurance with their seed. So they sell a fortified seed to farmers that will give a better yield of the farming products, but it is a little bit more expensive than what farmers would usually buy. Along with buying the seed, they get an insurance against drought. And the way for this product to keep the costs low is that they actually have rain stations across the countries where farmers use that product so that they can use that fact base, that index, to determine whether or not there was drought and whether or not there needs to be a payout. This insurance is integrated when you buy the seed. And there's a lot of debate about that. Is that a cross-sell that is inappropriate? In this particular product, I think it is not. I think it is actually something that enables people to go over that hurdle of having that slightly more expensive seed that will give them a better yield. And because it is embedded, so it's sold in combination, people don't need to fully understand what the insurance is because it comes in a combined package. And as and when they need it, because drought hits and the seed hasn't come to fruition, they will get a bag of new seeds.
Adetorera, two key concepts that Carlijn raises. The one is appropriateness and the other is the appropriateness of bundled services. I'd like us to just get your views on whether we're getting the balance right when it comes to pushing financial inclusion in underdeveloped financial markets, which is a common scenario on the African continent. What are the implications of that particular scenario?
Okay, if we look at the African continent, basically in terms of financial inclusion, I think one of the basic things that need to really happen is awareness. And the awareness has to get to the grassroots. We were talking about the insurance, basically. If you look at the insurance industry, it's even underserved, if you look at it. And that's basically because there's lack of general awareness of what insurance can do, or what typical benefits you can get from insurance. Another thing is also the trust. In terms of the banking system or the financial system, do the underbanks or the unbanks have any trust in the financial system? The other thing is even affordability, really, in terms of can it be easily affordable when it comes to insurance or some typical banking products. And those are the three key issues that need to really be addressed. We need to put out the awareness out there for the unbanked to really understand the benefits of financial products, being able to be in the formal banking system. We would always emphasize what the mobile banking has done. If you look at the M-Pesa case study, it's easy right now to actually buy insurance from your mobile phones. And those are some of the innovations that need to come into play when we're talking about financial inclusion, particularly for the underbanks.
Jude, as we wrap up the show, let's get a final comment from you just to encapsulate everything. And the question then becomes, with all the analysis that we've heard over the past half an hour, how do we strategically ensure that we grow the financial services sector on the African continent on the back of a rising middle class? What do you think the way forward is?
I think it's just to encourage financial services institutions to begin to make very good use of quite a load of data being made available by certain institutions. And what you find in the data they try to provide is that there lies a great deal of opportunity that has good economics behind it in banking the underbanked. What is most important there is that we have the right product, and somebody mentioned that in this program. It has to have a relevant product to these people, so you must understand them and come up with a solution that makes sense to them. And like I said, the first and quickest way to start is the payments platform. This is what they're already used to doing, though informally. You move to savings, and of course go to credit, and then I say migrate to insurance and pension. So if you stage it that way, you find that easier to handle. Then secondly, regulation. I think that regulators have a great deal of a role to play in creating the awareness that we've talked about today. And I think if you create that great deal of awareness and also find out that conflict resolution mechanism is in place when people have issues, they can easily settle them and get redress, then that also improve on the trust and credibility of the entire system. So I think it's based on the need of the service provider to see that there's benefit in providing the services to the underbanked and unbanked, and at the same time have the regulators help in creating the awareness that is required to support it.
On that note, I think we have come to the end of the show. A very big thank you to Carlijn Nouwen, partner at Dahlberg, and joining us from Lagos, Adetorera Banjo, Senior Manager of Management Consulting at KPMG Nigeria, and Jude, Anele, Head of Direct Banking at Diamond Bank. For you at home, if you would like to be a part of these conversations, you can certainly do that. That's by sending us a tweet. The hashtag is InvestAfrica, following me at The Real Nozi or at CNBC Africa. Let us know what you would like to see on Invest Africa. From myself and the team, it's goodbye.
Invest Africa, proudly brought to you by KPMG.